Hey everyone, welcome in to another daily editorial here on the KE Report. In this daily editorial, introducing a new company to the show, a company that I think all of you know fairly well, though. It is Gold Royalty, traded on the NYSE under the symbol GROY. We are chatting with the chairman and CEO, David Garofalo. Now, Gold Royalty, I guess part of the junior royalty space, but the company really grew through corporate acquisitions from about 2021 onward, bringing in a lot of different royalties, 240 royalties right now within the company's portfolio, and started to consolidate the junior sector. We're going to get David to walk us through how the company came together, that initial strategy of bringing in all these royalties, and now what the strategy is going to be moving forward, as well as talk about some revenue forecasts and valuation metrics. So, David, thank you very much for joining us on this show. Let's start off with a bit of the history of Gold Royalty. Look, it was, let's say, 5-6 years ago when we saw a pop-up of a lot of junior royalty companies with, let's say, 1, maybe 2, maybe 3 cash flowing royalties and a whole lot of other royalties. Gold Royalty came in and started picking off some of these higher quality royalty companies in the junior space. Take us through that strategy and where you're at now.
Yeah, absolutely. And thanks, Corey, for having me on. And Shad, delighted to be here. Yeah, I think it's worth maybe discussing a little bit of the history of the company, its origins, because that origin story, I think, informs where we are today in a large degree and the multiple platforms we have to grow from now, not just M&A. But yes, we started back in late 2020 as a private company with 18 royalties written on our former parent company's assets. Gold Mining Inc. has a collection of development stage assets through the Americas, all gold, with a gold equivalent resource north of 30 million ounces. So a very significant mineral endowment. And we had the idea of both reorienting that company to focus on advancing those projects, but at the same time writing royalties on the properties and creating a royalty vehicle, which would be a source of liquidity for gold mining that could then invest on those underlying assets. We took that royalty company with 18 royalties public in March of 2021, looking to raise $30 million US. And it was a much firmer gold tape back then, even more than we're experiencing today, in spite of the fact that the gold price is considerably higher. But we were looking to raise 30 million and we raised 90, and we achieved a post-money valuation of $200 million. And we got a healthy valuation, and recognizing that we had a robust currency, we recognized the need to consolidate and also diversify our portfolio beyond the 18 that we inherited from the gold mining spinout. And in doing so, bought Golden Valley, Abitibi Royalties, and Ely over the course of 2021. And that added 150 new royalties into the portfolio and brought in some cash flowing royalties and some significant growth, and provided us that foundational element that we really clearly needed to establish ourselves within the royalty sector. And you'll remember in 2022, the Federal Reserve started to tighten early in the year, and we saw a massive derating of gold equities generally, but in particular stocks that had significant growth like us were punished disproportionately. And recognizing we simply didn't have the currency to consolidate companies anymore, we started growth through other means, and that included doing some project financings, some third-party royalty acquisitions, and in acquiring Ely and Golden Valley, we inherited a small team in Nevada and Quebec, respectively, that generate royalties organically through their sweat equity. So we now have 4 platforms for growth, and that's what's brought us from 190 royalties that we were able to get through consolidation to over 240 royalties today.
Well, David, let's dig into some of the growth that's projected on your gold equivalent ounces. And for those listening in, since a royalty company is not actually doing the producing, they're getting the benefits of having strong operational partners. Everything's reported in gold equivalent ounces, but maybe break down if there's any other metals in there, the leverage to the gold price, and how you see the revenues and the gold equivalent ounces growing in the years to come.
Yeah, look, 92% of our underlying exposure is still gold. We have over 120 million ounces of gold equivalent resource on the underlying assets upon which we have royalties. And that's grown from the 30 million ounces we started with in our IPO and gold mining's assets. So we have realized significant accretion in terms of not only absolute reserves and resources, but absolute reserves and resources on a per share basis as well, as a result of the acquisitions we've done, either through M&A or through third-party acquisition of royalties or project financings. but also through the exploration efforts of our underlying operators. Our operating partners invest on average about $200 million of exploration per annum on our underlying properties, and we get the benefit of that exploration upside without having to contribute to their exploration budgets. So, we have seen significant accretion organically from our portfolio in the reserves and resources on a per share basis. But our revenues, as you correctly pointed out, are growing exponentially as well. Last year was our first full year of revenue in 2023, and we produced about gold equivalent ounces, a little over 2,700 ounces of gold equivalent. This year, that's more than doubling to close to 6,000 ounces. And then you're going to see significant accretion through the end of the decade. It brings us to between 26 and 30,000 ounces of gold equivalent on the existing asset base of royalties we currently have. So you're looking at about 160% revenue growth this year and about 60% on a compounded annual basis right through the end of the decade from assets that are either producing cash flow currently or in the late stages of construction and development, and will be ramping up and are ramping up over the course of the next 18 months.
Let's talk valuations then, because on your slide deck, you have a price to NAV valuation metric here where you're showing Gold Royalty is undervalued. So break down that valuation, but then also compared to, I want to know more where you rank valuation wise when it comes to revenue as well.
Yeah, so look, I think on the valuation side, you're pointing out to is not our own. It's actually a composite of the analysts that cover us. So it's a consensus estimate of P to NAVs, not only for ourselves, but some of our direct peers and some of the larger peers as well. The category killers in the space, the Franco-Nevadas, the Wheatons, and the Royal Golds are typically trading at 2 to 3 times NAV just based on their significant scale, the quality of their assets, their management. In fact, they also have first mover advantage. They're the oldest royalty companies in the space, so have had a bit of a running start against the rest of us and have built up that critical mass over time. So there is a disparity between our multiple and not only the large cap guys, but I would say among our smaller cap peers as well. And I think that's a function of the fact that we have the highest growth rate in revenues and gold equivalent ounce production in across our sector, not only among our peers, but also across the entire universe. And, this is a sector and an equity market that's severely discounted growth, particularly as interest rates went up. Anything that had any growth in it was severely penalized. And I would say that we were disproportionately penalized coming into the tightening cycle relative to where we were in 2021 when there was still a very strong gold tape. We were the top performing royalty company in terms of share price performance in 2021 as we were undertaking that consolidation, and that helped accelerate the consolidation efforts we undertook. But then as the cycle turned, the growth stories were very significantly impaired, and that's why we find ourselves where we are today. That being said, all that growth that we've been promising, we're actually in the middle of it right now. As I said, we're having 160% revenue growth this year. That's what we got it for, and averaging about 60% compounded annual growth right through the end of the decade in our revenue. And that's coming from some of the largest producing assets in North America. We have royalties on 3 of the 5 biggest producing gold mines in North America, including Canadian Malartic, Côté in Canada, and the underground extension of Goldstrike, North America's biggest producing gold mine, the Ren deposit, which has already delineated 2 million ounces on very limited drilling. And as they get underground, they see the potential for that to go to north of 5 million ounces, and we have an exclusive royalty on that asset. So we're in an excellent position to deliver revenue growth, not only on an absolute basis, but on a dramatic per share basis. And, we're looking at ending the decade, if you're using current gold prices, at around $70-80 million of revenue. And if we use the same kind of multiple on revenue that Franco-Nevada enjoys, for example, we'd be a company about $1.4-1.5 billion market cap versus a $230 million market cap that we currently are experiencing.
Yeah, David, definitely some room for re-rating for the company. And I think some of it is going to come from the growth on some of those large mines you outlined. In your slide deck, you do talk about some of the cornerstone assets, but you already mentioned 2 of them. IAMGOLD's Côté mine that just went into production this year and is currently ramping up. And you also brought in the part about Canadian Malartic, which people will remember is one of the largest mines in Canada, has this Odyssey zone that you have a royalty on that's going to be ramping up. So maybe talk about the ramp up in production with some of these operational partners.
Absolutely. With Côté, they did start production earlier in the year. They achieved commercial production about a month ahead of schedule just this past August. and expect to be at nameplate capacity by the fourth quarter. And we have a 0.75% royalty on Zone 5, which is the southern part of the pit, which has the highest grades. And we expect a very rapid payback on what was initially a $16.5 million investment. We're expecting at current gold prices to be paid back on that investment in under 3 years. So it was a very fortuitous acquisition for us. I would add, from the estate of a deceased prospector who had done some of the original staking on that property. And that's been, again, critical to our growth, is finding those third-party royalty acquisition opportunities. That's been an instrumental part of our 4 platforms of growth. So Côté is going to be a 500,000 ounce a year producer. So one of the biggest producing gold mines in Canada, not number 1, certainly number 2 or 3. And we will be in the heart of the deposit with our royalty right through the first 5 or 6 years. And that's when we're going to get not only a payback on our capital, but a significant return over and above our initial investment. At Canadian Malartic, we do have some limited royalty coverage on the open pit. We're enjoying a $2 to $3 million of revenue per annum from the open pit, but we have much broader royalty coverage on Odyssey, the underground extension. That's a $1.6 billion mine construction that Agnico's undertaking underneath the current resource at Canadian Malartic. So they're going from an open pit operation to exclusively underground over the course of the next several years. And once we're underground, they're looking at about 500,000 ounces of production per annum from the underground, and not dissimilar to the production levels from the open pit currently. But we're going to have royalty coverage on almost half of that production base. And so that means, at 3% NSR, we're getting upwards of 7,500 ounces per annum of gold equivalent attributable ounces to our account. So that's quite a significant step up in revenue at current gold prices. That would be, almost a tenfold increase in our revenue from that one asset. But we see a lot of upside from there, because they're talking about sinking a second and maybe even a third shaft in Canadian Malartic, because they're going to have a very hungry mill as they go from open pit to underground production. They'll have over 40,000 tons per day of spare capacity in that mill. So it definitely behooves Agnico Eagle, my old shop where I spent 12 years as CFO, to invest meaningful capital in getting at more ounces more quickly to feed a hungry mill. And on top of that, we have quite a bit of royalty coverage on contiguous land positions around Canadian Malartic, which means that we have a lot of optionality on any near surface discoveries that Agnico makes to feed that mill more expeditiously. So that's an exciting element. It's not only revenue growth, but massive exploration growth from a deposit that they're looking at adding more infrastructure to, but also as they gain access from underground, they actually are able to expand their exploration horizons. And we have a lot of royalty coverage in some of the more prospective ground underneath once they get that access and get the drill setups they need to really intensively drill this deposit from underground. Ren, I mentioned earlier on, coming, we hope, into production in the next couple of years. It's a plus 7 gram a ton deposit that Barrick's delineated just under 2 million ounces on initially. That's versus the less than gram a ton they're mining from the open pit. Obviously, it's a well-infrastructured area, so they have a massive plant there, and they have the capacity to sequence some of this high-grade material into the mine plan in short order. But what's more exciting, as far as I'm concerned, in addition to this production potential we see in the next couple of years, is they are now developing into the deposit with a ramp from the bottom of the pit. And as they develop into the deposit, they're also getting underground exploration setups. And what Barrick has advertised to us is plus 5 million ounce potential on this deposit and 200,000 ounces of production per year on a conceptual basis. So that is likely to be into the mine plan in relatively short order as Barrick looks for higher grade feed to supplement what they have from the open pit there. We've also added some other cash flowing assets into the portfolio in the last year. We brought from, again, a third party, a royalty on Cozamin, which is Capstone's highest grade copper mine in Mexico. And we also bought a royalty on Varus, a copper stream, I should say, on the large scale zinc silver mine with almost 20 years of reserve life in Bosnia, operated by Adriatic Metals out of Australia. That started production this year and expected to achieve nameplate capacity in the fourth quarter. We have a 100% stream on their copper. And then finally, I would add that we did a project financing for the new mine that Aura is building in Brazil, Borborema, which we'll be producing about 150,000 ounces of production starting next year. But with the novel financial structure we have in place, we're getting pre-production royalty payments while the mine's in construction this year. and also getting revenue or interest on a gold-linked convertible note that we've used to help finance the project as well, which we can then convert into a further NSR. So lots of moving pieces here and lots of diversity in terms of our growth, contributing to that massive growth profile that I talked about a little earlier on.
All right. Thanks for recapping all of those, David. I will be posting slide 10 and 11 from the recent slide deck that outlines the 4 cornerstone assets as well as this pipeline of assets from exploration the whole way to cash flow, so everyone just gets a good image of where the company stands. Let's talk company strategy moving forward, then tying in financials here. I see you have a credit facility for $35 million. $25 million is drawn here. When it comes to strategy to continue to grow this royalty portfolio, even though you already have 240, where do you see the opportunities and how do you go about making those deals happen?
Well, we've been almost exclusively focused on cash flowing, near cash flowing royalties in the last year to bridge the gap between our now and our very significant growth of some of those large scale assets that I mentioned earlier on. And I feel like we have a very diverse and full portfolio, and we'll continue to focus on generating royalties organically. And what that means is staking exploration claims around existing mines and deposits, farming the properties out, and take royalties and option payments back in return. So really, that's generating royalty opportunities through our sweat equity in Nevada and Quebec, and that's generated about 2 to 3 new royalties per quarter. And again, effectively zero cost, with the kicker of option revenue on those properties from the underlying operators. And last year, for example, we generated over $3 million of option revenue that almost covered half of our G&A costs corporately. So that's not only been a fruitful source of cheap royalties for us, but also option revenue to help defray and mitigate our operating costs as a company, which are quite de minimis because we don't undertake any exploration. We're a pure play royalty company, and we could run a business 10 times the size with the same 8 employees that we have currently. So it's a very scalable business, but it's good to have this little kicker here that helps mitigate our G&A costs.
Yeah, David, nice to see those options payments coming in just to bring in extra revenue, cover some of that G&A. But I want to dig into this strategy a little further because you lay out that you have these 4 unique pillars of growth, and they're really the different ways that a lot of royalty companies behave, but you're doing all 4. So the royalty financing is almost what some would call royalty creation, where you're lending money to the company that's developing a project in exchange for the royalty. You've got third-party acquisitions, either individually or maybe a basket of them at a time. You've got the corporate M&A where you take over other royalty companies. And then you also have royalty generation, more the prospect generator model. A lot of companies do one of those or maybe 2 of those, David, but you're doing all 4. So maybe just speak to how that's a distinguisher for the company.
Look, we've been as careful about curating people as we have assets since we started the company. And I feel like we punch above our weight in that regard. And that's what's really equipped us to be able to grow through all 4 pillars. You're right. We're unique in that regard. Some royalty companies and streaming companies are singly focused on one of those pillars or 2 of them, but there's nobody else other than us that does all 4. And that's because collectively we have over 400 years of industry experience in my very small board of management. We have 6 directors. We have 8 employees, including me. That's double counting because I'm both on the board and the management team. So, from a very small team, a lot of collective experience, which gives us 2 distinct advantages. One is, we can punch above our weight in terms of being able to do M&A, doing royalty generation, doing third-party royalty acquisition, doing project financing, because we've done all of that. We've all been operators and developers. Many of us have within my management team and board. So we bring that perspective. We are able to appropriately price the risk of what we're buying because we've been in those boots before. We built an operated mine, so we understand the inherent risk in those mines, and we can price that risk appropriately. But with over 400 years of industry experience, there isn't anybody in the entire mining industry that one of my board of management can't pick up the phone and call. In every senior bulge bracket company, my head of corporate development, John Griffith, ran Merrill Lynch's mining group for a long time. So his clientele was all large cap. My CFO, Andrew Gubbles, ran UBS's mining group for quite a long time. Again, he covered the large cap universe. On my board, Warren Gilman's been a financier of the sector for over 30 years, runs Queen's Oil Capital out of Hong Kong, has been a cornerstone investor in the company. Alan Hare was my chief operating officer at Hudbay when I was the CEO there, a prolific mine builder, and was my successor as CEO when I left to go run Goldcorp. So again, a lot of expertise and capital markets access within the organization and mining industry access, which has really afforded us an opportunity to be multi-talented in terms of how we grow our business.
All right, David, thank you very much for this overview of Gold Royalty. Again, David Garofalo, Chairman and CEO of Gold Royalty, traded GROY on the NYSE. I will post a link to the company's website below this interview. Feel free to click that link, send us any questions you have for David, and we will follow up with him and the team at Gold Royalty as we get some more news, any developments on any of the assets moving forward in the company's pipeline. David, thank you again for your time.
Thank you.